With a talented summer in clear sight, it took me a little bit longer to complete this quarterly commentary than I'd hoped. But I did at least get to enjoy some family time on Canandaigua Lake. And I'll get to enjoy a little more time there as we head into the last week of August and the Labor Day weekend. I hope you've enjoyed your summer at least as much as we've enjoyed ours. Now, the old saying, sell in May and go away, that really came about as a result of many people in the financial industry taking the summer off and going away for a couple months. And somehow it turned into the idea that the markets didn't do that well during the summertime. And while occasionally that is true, it's actually more common that the markets continue an upward trend over the summer. As a matter of fact, this summer is a great example. If you had sold in May and gone away, you would have actually sold in a month that realized a 6.58% decline in the S&P 500. And June would have proven a good month to stay invested, as the S&P 500 realized a 6.89% increase, followed by 1.31% in July. Truly a year that would have proven beneficial to stay invested in the summertime. All that said, the markets seem pretty determined to present with volatility. As a matter of fact, Vanguard issued their 10-year outlook for stocks and bond markets, and in late May, they forecasted a 4 to 6% return for U.S. equities, a 2.5 to 4.5% return for U.S. bonds, 7.5 to 9.5% for international equities, and 2 to 4% for international bonds. While the last decade has proven a very strong decade for U.S. equities, it seems that many are predicting a lower return for the following decade. Now, this is actually somewhat reminiscent for me of the strong U.S. performance throughout the 90s, followed by the lost decade, which was at the start of the 2000s. Many of you will remember this as well. International equities actually outperformed the S&P 500 in all but 3 years, from 2001 until 2009. Could we see a familiar fate for equities in the coming decade? Time will obviously tell. Our philosophy remains the same, one that recognizes the markets are very difficult, if not impossible, to predict, and will continue maintaining a diversified portfolio with an emphasis on overweighting to those undervalued markets. Other noteworthy news includes the potential passing of the Setting Every Community Up for Retirement Enhancement Act. This is also referred to as the SECURE Act. This is the first major retirement plan legislation since 2006, and it brings a significant amount of change to retirement plans. One of the more positive changes is a potential increase in the age for required minimum distributions from age 70 and a half to age 72, with the Senate also considering using age 75. On the negative side, the act will have a big impact on planning for clients with substantial retirement account balances who have intended to leave those assets to loved ones and spread the distributions out over their loved one's lifetime. Instead, the act requires those distributions to be distributed over a 10-year period. The bill hasn't yet passed the Senate, and given the packed schedule that they face, it may end up in limbo until after the 2020 election. For more on the SECURE Act, feel free to reach out to us. And as always, thank you for taking time to enjoy our quarterly commentary, and feel free to share this with others. Until next quarter, have a wonderful end to your summer. Thank you.